to get started with your first rental investment property, but not sure which to start with?
Today we're going to show you all the numbers that are involved in analyzing a duplex so that you can get started investing today.
If you haven't already, click the subscribe button and ring the bell so that you get notified every week when we drop a new video.
It's so exciting thinking of, oh my God, that first investment property. But then you're like, oh, it starts getting a little scary when you start to realize you don't really know what the numbers are or what to even look at.
Or what you're doing. Today, we're gonna break down all the numbers for you, like all the things. Well, let's start with the duplex, right? We're talking about a duplex. So,
Yep.
Okay, you got rent number 1 from door number 1 and rent number 2 from door number 2.
That was complicated.
I mean, I don't know if I get that. Can you rewind it? And what are the common operating expenses? Like what's typical? You got property taxes, insurance, property management, maintenance, and utilities. That's pretty comprehensive, right?
Pretty much.
Yeah.
Okay, so you live in your home. If you own it, then every month you're paying the bank, right? That's your mortgage payment. In the world of multifamily real estate, it's a mortgage payment, but we call it, the terminology is debt service. So let's just talk a little bit about what is debt service? What makes up the mortgage, so we can start laying that foundation. Okay, so there's 3 primary things we're gonna be talking about. The LTV, which stands for loan to value, which basically creates the loan amount. So for example, let's say you're buying a property for $200,000 and you're getting a loan that is 80% LTV or loan to value. That means the bank is gonna give you a loan that is 80% of that 200,000. Okay, so that'd be 160,000. So the very first thing that's gonna impact the mortgage is how much is the mortgage? 160 grand. Okay, that's done. Next is interest rate. So if you have a 3.5% interest rate versus a 6% interest rate, that's gonna impact what your mortgage payment is every month. So interest rate is one of the 3 things. The third is amortization period. What the heck is that? So you've probably heard before, a 30-year fixed term. So when it comes to amortization period and really loan terms, there's a lot of different ways it can go. We're gonna keep it simple for the purpose of this particular video, but know that amortization period is the timeline that the bank is spreading out the payments until you're done paying. So for example, a 30-year amortized loan means that over the course of 30 years, you're gonna make the same payment every single month. And at the very end of 30 years, that mortgage will be to a balance of 0. Now, if it was a 20-year amortized loan, then your payment would actually be higher because the whole thing is set up so at the end of year 20, it's paid to 0. So your loan amount, your interest rate, and the amortization period are all gonna play a factor in what your mortgage payment or your debt service is. And that's gonna impact your cash flow.
If you're liking this video so far, click the like button below. Help us out, give us some love.
I'm just curious, this is not that complicated, right? When we break it down, this isn't that complicated. What do you think it is that keeps people from just going for it and doing it?
Oh, it's 1,000% a mindset issue. And what usually comes from is the fact that what we don't know, what's unknown, is a little scary. Yeah. But once you get clarity on what everything means, then you have the information that you need and you're armed to make a decision. And then what happens next is once you're armed, you want to stay in that knowledge zone, right? People just want to keep getting more knowledge so that they're more comfortable. But I'm telling you, once you have the basics, you have the knowledge that you need to try to take that first step and start exploring things and crunching numbers at least. Then you have even more clarity. And it's really a mindset thing. The more you know, the better you can decide.
If you haven't started yet and you haven't bought your first duplex, what's holding you back? Comment below and let us know what is it that you feel like is holding you back. And maybe we can give you some advice to help you get unstuck and get into action.
All right, so I feel like we have an opportunity here to break it down a little bit further for you. What do you think about crunching some numbers? I feel like it's a whiteboard opportunity.
Totally.
Right? Let's calculate the net operating income first, the NOI.
Okay, so let's start with the basics of net operating income. All right, so in order to calculate net operating income, we need 2 things. We need the revenue and the expense. So let's dial back a little bit and break those down. All right, so let's start off with rents. All right, let's just say, for example, that we're renting a duplex that rents out for $800 per side. All right, so we have rent number 1, $800, rent number 2, $800. Okay, so keeping it simple, we have total revenue of $1,600. All right, so let's get into some of the common operating expenses. Jen mentioned them earlier. Let's throw some numbers to them for the purpose of crunching some numbers. Let's say that property taxes are $150 a month. All right, and let's say that insurance is $100 a month. Okay, property management is typically 10% of the gross rents. Now, we already established that total rental income is $1,600. So let's say that monthly property management is going to be $160. Now, when it comes to maintenance, we never really know what maintenance is going to be. So when we're crunching numbers, we always, and this is assuming that this is a renovated property or there's really nothing major wrong with it, we're going to throw in a reserve of $50 per unit per month. Some months we have nothing to spend money on. Other months we have something that is $300. So it's good to plan for that expense so when something comes up, you've already budgeted for it. So we're going to say maintenance is $100 a month. Now with utilities, I want you guys to be aware that utilities can be a thing, but the way that we have always run our portfolio when it comes to duplexes is we do not pay any of the utilities. And when you start getting into larger properties, probably even as early as a fourplex, definitely apartments, it's pretty common for the landlord to pay the water and sewer. But I'm telling you, for a duplex, even if you have 1 meter for both water and sewer, I always instruct my property manager to let the tenants know that they are still responsible for it. So it will be in my company, my LLC's name, the bill, but every month we bill out the water and the sewer to the tenants. So in this case, I'm gonna say 0. So our total operating expenses for the month are gonna be $510. Okay, so getting back to net operating income, we now have the 2 numbers that we need. Revenue, $1,600, minus expenses of $510. So how much is our net operating income now? It's $1,090. All right, now the reality is you're probably not buying it cash. Most investors are going to get a loan, right? But if there was no loan, this is basically what's left. So in order to figure out what your cash flow is, your net cash flow that you can start adding to your bank account every month to slowly but surely start replacing your job income, we have to subtract our debt service or mortgage payment to see like what's actually left. So let's do that next. So we had $1,090 NOI, but we also have to figure out what the mortgage is. So let's calculate that real quick. Okay, so let's figure out what the mortgage payment's gonna be. Remember, we talked about that there are 3 things that impact what the mortgage payment's gonna be. LTV or loan amount. Let's just say, for example, our purchase price is $160,000, right? So we're buying this thing for $160,000. The loan to value, let's just say the bank's gonna give us an 80% LTV. So 80%, let's move this over a little bit. So if we're gonna get 80% of $160,000, how much is our loan? It's $128,000, right? So $128K is our loan. That is how much the bank is giving us to buy the property. Now we have to come up with the rest. We have to come up with the other $32,000, all right? But this is impacting our mortgage. Now there's interest rate and amortization period. So let's just say that the interest rate is 4% and the amortization period, get it, period, is 30 years. Okay, so with all of that being said, that means our monthly mortgage payment, move over, is gonna be $611. So out of that $1,090 that comes in every month, we're gonna have to send back out $611 to the lender for lending us the majority of the money to buy this duplex. So let's go back and see, what does our cash flow look like? All right, so let's throw our mortgage payment in there. So minus $611. So how much cash flow do we have on this fabulous little duplex? $479 a month. That's not bad. If you break it down, that ends up being about $239 per door per month. If you watched other videos from Jen and I, you know that when it comes to doing small multifamily, we're pretty much shooting to be somewhere between $200 and $250 a door. So this fits right in there. So at $479 a month for this duplex, how many of these duplexes do you really need to be able to say, bye-bye, boss, and leave your job? And that's the whole idea, hitting them one at a time and just knocking them out. And frankly, it takes a lot less time than you think to get into the game and be able to create that financial freedom. All right, let's cover one more quick little thing. There's something called cash on cash return. Super exciting, super important to us investors. So cash on cash, you'll see it sometimes as COC percentage. So you have to figure out like, how is your money working for you? Let's just say, for example, that we have about $5,000 of closing costs and lending costs, right? We already know our down payment was $32K. And let's say that our costs were another 5K. Okay, so our all in from cash is 37K. Okay, that's our all in. So to figure out what our cash on cash return is, we're gonna take that $479 a month and we're gonna multiply it by 12, 48, right? In order to know how is my money working for me, I have to put out 37,000 in order to get that 5748. So I'm gonna divide 5748 annual cash flow divided by my investment of money, which is 37,000, and that is a 15% cash on cash return. Not bad.
Imagine getting $479 a month in cash flow, and that's just with one. You could do it again and again and again and again and just make it rain. If you do want to get into multifamily real estate investing, but you're not sure what's the first step, the second, or the third, you can click the link in the description below and a member of our team will hop on the phone with you and talk about your goals, your resources, and how we can hold your hand and get you to where you want to be.
The other thing we want to tell you is that we have a free Facebook group. It's called Multifamily Real Estate Investing. So if you want to be around people that are like you, on the journey, looking to learn, come join us in that Facebook group. We do tons of free education and content there. And every week, Jen and I make ourselves available for a question and answer session. It's live, it's in Zoom, we're face to face. You gotta come to the Facebook group, register, go to events, and then we'll see you there. But any questions you have about real estate, we're there to answer them for you.
If you want to learn more from us, watch this next video on how to build your real estate portfolio remotely. See you next week.